Gordon.
Another company I've never heard of, opening the New York Stock Exchange. There you go. Woo. From New York City this morning. Good morning. I'm joking. It's a joke. Futures positive, 0.4% on the S&P and the Nasdaq, up 1 percentage points. A bounce back after 3 days of losses on the S&P 500. 3 days of losses down 5% on the S&P. Will this bounce stick? As your opening bell, switch at the board and get to the bond market. Yields look like this. Yields higher by 2 or 3 basis points on a 10-year. 312.87 euro dollar at parity. Just about negative 1/10%. Sterling came really close to a 115 handle a little bit earlier this morning. Crude right now 89.66, 89.70 is a break of 90. We're down more than 2 full percentage points. That's the cross asset price action. Let's get you some moves at the open. Here's Katie.
Well, John, similar to yesterday, you have big tech leading early gains, thanks in large part to Amazon. Shares up about 0.6% after 3 straight days of losses. We'll see if that move holds. Moving on, though, you have Bed Bath & Beyond plunging after revealing its turnaround plan this morning. That, of course, involves shutting 150 stores, cutting 20% of its workforce. The company hopes that'll reduce costs by about $250 million, but you can see it's hitting shares hard right now, down 25%. Snap, this is interesting. It's a similar story, but an opposite reaction. Snap also announced job cuts this morning to the tune of about 20% of its workforce to rein in costs, of course, as ad revenue slows. It's also adding Jerry Hunter as its COO. As you can see, investors seem to be cheering that early. Shares up almost 10%. HP, though, it's a different story. Under pressure after reporting that sales missed estimates. Falling PC demand also led HP to cut its profit forecast. You add that together and shares are about 7% lower.
Katie, thank you. Stocks on the move, as they always are at the opening bell by definition. On the S&P 500, up 1/3%. The bottom of the pile, energy down 1.4%. Struggled with the move lower in crude we've seen recently. We're down about 2.5% on Brent, 96.66. On WTI, I mentioned that earlier, a break of 90, 89.54. Big tech closing in on another monthly decline. A lot of that's come in the last few days. Looking ahead to September, historically the worst month of the year for the Nasdaq 100. Abby is back with us for more. Hey, Abby.
Hey, John. Well, this is really just brutal. We see that year-to-date decline in the Nasdaq 100 of 23%. And I'm taking a look at one of the functions in the Bloomberg terminal, the HCP function, and the Nasdaq 100 up only 2 months this year. That's how brutal the decline has been. And of course, this month set for another decline. Now, right now, we have a little bit of a bounce back. Let's see if it sticks, because of course, to Katie's point, we were a little bit higher yesterday. The chips, the stocks under pressure in particular, supply chain constraints, demand. But of course, the big story here, yields. Yield's not doing all that much today. That 2-year yield basically flat. But that's not the story on the year or the month. On the month of August, the 2-year yield is basically up 50 basis points, going from about 3%, below 3%, to about 3.45%. As yields go higher, of course, that means everything becomes more expensive. It just speaks to how dislocated markets have been around the Fed. That supposed Fed pivot out of the July meeting that really was never in play. Well, yields reflected that. That pressured tech, big tech, the Nasdaq 100 down. And of course, we are going into the seasonally difficult time. I would have thought that it would have been October, the worst month, but for the Nasdaq 100, John, it is all about September. The average decline over the last 5 years has been down 0.6%. And of course, if you recall, back in 2018, that very difficult fall, it started with a minor monthly decline in the Nasdaq 100. Who knows? We've had so many monthly declines this year. It seems as though September, will it be more of the same? It could be absolutely brutal if so, John.
Abby, thank you. The end of August has certainly been just that, brutal. Abby, thank you very much. I was just looking at the S&P 500. It's still 8 or 9%, close to 9 percentage points higher than the June low. At the same time, the bond market at the front end has taken out the June high on a 2-year. Remember, the previous high on a 2-year was June 14th. The low in the equity market was June 16th. Right now, your 2-year up a basis point, 345. So that is above and beyond where we closed on June 14th in the bond market. So if you've got the high of the year on a 2-year, should we have the low of the year on the S&P 500? Should we revisit the lows of June? Morgan Stanley's Mike Wilson calling this market a victim of its own momentum. Taylor Riggs has more. Hey, Taylor.
John, pull up this chart because this highlights exactly the time frame that you were just talking about. The equity market lows of mid-June, the big rebound, and this is where the debate comes in. Was this a new bull market as we had valued up here, up 20-25%, or just a really big bear market rally? And then unfortunately, from the peak in August all the way down to now, you've erased actually half of those gains. So as you mentioned, you're still only up now about 6 to 12%. Off of the big lows that we had mid-June. So that really is the question. Huge question when we think about QT, and I know that you're going to be talking a lot about this in September, the financial conditions. They're loosening, they're not tightening. Is this actually what the Federal Reserve does not want to see? The whole point of this, again, with that huge big equity rally, was the loosening of the conditions that maybe the Fed did not want to see. The fundamentals, though, John, actually still look good. When you think about, I'll be taking a look actually at the earnings if we have that instead of sort of the individual snap companies. Broadly, earnings are actually still seeing an upside surprise. As the moments went on, as the weeks went on, John, earnings actually came in a little bit better than expected, leading to some of that optimism.
This is what Mike Wilson's talking about. He thinks this is the moment for Mike Wilson. It's all about the earnings. Taylor Riggs, thank you very much. It's all about the June lows. Are we about to retest them? Jack Caffrey of JP Morgan Asset Management joined us right now. Jack, help me out with that question. 3-day losing streak on the S&P. We're down about 5%. Are we looking for a retest here at the June lows?
I don't know that we have to retest the June lows, but I do think the equity market is to some extent the tail that's getting wagged by the bond market. And so to the extent we actually, I think, need to see some stabilization starting A, in the rates market, B, moving into the credit markets before we're really going to see the equity market find its footing in the shorter term. As Taylor just was pointing out to us, we saw a very substantial rally. We can debate whether it was a bear market rally or just a nice rally within an overall market, but that was really prompted by the earnings story. And so, over the next month or so, we're going to have to listen to what we hear on earnings. Companies are taking some steps to fortify their earnings. We talked a bit about that. And some companies are offering some negative guidance, trying to get ahead of where they might see some demand problems. But I think shorter term, it's going to be messy until we can anchor on something more stable.
Jack, what do you have to see, though, in the shorter term to gain a bit more confidence? I brought up this quote from Strategas yesterday. They said that market bottoms usually associated with lower earnings multiples, a higher VIX, a blowout in high yield spreads. We've not seen that yet. Is that what you need to see to get past this hump?
I do think we need to see some more, what I hate to say is more technical panic. In all likelihood, you have started to see some moving higher in put buying. The VIX, implied volatility in equity markets moved higher, but I do think the equity markets volatility is still taking its cues from fixed income volatility. It's a little dangerous when the equity portfolio manager is talking about the bond market, but when I look at the MOVE index, that's sort of in the 120, 130 range and not really making any progress lower, it seems like until we get economic data which is more aligned with what the Fed wants to be hearing, I think equities are going to be taking their cues from interest rates rallying in the shorter term, making this future earnings power a bit pressured. And when the consumer does or does not respond to those higher borrowing costs, you certainly see it, say, in big ticket purchases. Look at the declines in mortgage applications today. So there is some sense that some parts of the real economy might be responding to rates.
What do you think will hold up, Jack? Because in the past you've given me the impression that you think this economy might prove to be stronger than people expect.
Well, I think one of the challenges we have when we try to understand this economy is there's almost no one who's operating, at least in the markets or to a large extent in the economy, that really had the benefit of what you might call the inflation mirage. The extent that top lines for companies are being powered by the fact that you're looking at whether it was 8 or 9% inflation on a headline basis. To what extent does that hide some of the pressures that we're starting to experience on costs? The issue that may unfold over the next several months, the bullish case is inflation rolls over. If inflation rolls over, then companies lose pricing power. And do companies get squeezed over the course of the next 6 to 12 months where their costs really aren't being able to be managed as well as they've gotten used to with still relatively tight labor markets while simultaneously losing pricing power? I also think we have to deal with this issue of what goes on in Europe. Europe is seemingly under considerable pressure. It's 15 to 20% of most companies, of many S&P companies' revenues. And so we can talk a lot about U.S. data, but we also have to be cognizant that the world is much bigger, and the stock market's exposure to the world is much bigger than necessarily the economic data we get on a daily basis about just days.
With that in mind, Jack, what does that mean for market cap, large versus small, given the Europe story?
Yeah, I think at the margin, smaller caps are probably more pressure in the short term over time. More pressure in the shorter term with some of the less able to pass on some of the inflation that they're currently experiencing, more exposed to some of the cost pressures. But over time, ultimately, I like the greater diversification I get from a global exposure. But that's a function really of wanting to compound over time rather than being particularly tactical. My own portfolio is much more globally oriented just because of the market cap needs that I need to traffic in for the strategy I'm attempting to implement for clients.
Jack, I understand all that. And typically, when we talk about a longer time horizon, we'd be overcoming some of these cyclical issues in time. Jack, when you look at the issues in Europe, the phrase that I'm hearing more of, the words I'm hearing more of, is that this won't just be a one-time thing, that you might have 5 winters of this, maybe even more, listening to the Belgian Prime Minister in the last week or so. The Shell CEO said we need to face reality, that this isn't going to be done and dusted with just this winter. Jack, how are you factoring that into your thinking about a longer time horizon, but ultimately a longer time horizon with the same issues?
When it's an overused saw, but one that I think bears paying attention to here, and that is high prices are the cure for high prices. So right now Europe is being forced to confront how does it solve its over-reliance on what is now revealed as an unreliable source of hydrocarbon supply. What that means for European industrials, what that means for the European consumer. I think that you're going to see, to be realistic, you're going to see some backtracking in terms of some of the pledges that had been made in terms of moving towards more greener technologies. And I think it also encourages Europe towards a greater diversification. Whether that greater diversification winds up meaning importing fuel from the United States, whether that greater diversification is trying to secure longer-term exposures to less problematic fuels in the form of liquefied natural gas. But ultimately, when we look to market solutions, they might not be clean and easy in the shorter term, but they generally get us to where we need to be over the intermediate to longer term. How that plays out necessarily in terms of Europe, not really within my specific bailiwick, but to the extent that Europe is an important part of the S&P, you got to watch it. And I do think that Europe is taking to diversify, but to some extent, Europe is much cheaper than the U.S. stock market. So that there's some greater sense of, when we think about these problems, they're neat and obvious. You can identify the controversy about investing in Europe right now. It's much cleaner, I think, than some of the controversies in the U.S. market.
Interesting. Jack Caffrey at JP Morgan. Jack, awesome to catch up with you, sir, as always. About 12 minutes into this one, equities bounced back just 0.25% on the S&P 500. On the NASDAQ, up by 0.6%. Long conversation there about Europe. It's such a big issue, not just for the Europeans, of course, but also for the multinationals listed here in the United States with exposure to the European story on both the FX side of things and in terms of the performance of the economy and what it means for revenue, for profit. Coming up, Europe has a big problem.
At European level, we have agreed that all member states do jointly save 15% of energy between August now and March 23.
And policymakers are looking for a solution. That conversation up next.
At European level, we have agreed that all member states to do jointly save 15% of energy between August now and March 23. The second pillar is we need to diversify away from Russian fossil fuels to reliable, like-minded sources, mainly also to fill our storages. And here's good news. We have reached now an average in the European Union of storage filling of 80%.
For once, the EU Commission President Ursula von der Leyen gets to deliver some good news. That 80% number well ahead of time, a couple of months ahead of time. The EU ramping up efforts to curb soaring energy prices as Russia tightens its grip on gas flows through Nord Stream 1. The French energy minister writing the following: Russia is using gas as a weapon of war. France has prepared for this scenario since the spring. The filling of gas storage will reach its maximum in about 2 weeks' time. This all coming as a record inflation print looms over the ECB's latest rate decision. Goldman, Bank of America, now looking for 75 basis points from the ECB next week. Team coverage starts right now with Lizzie Burden and Jack Fauci in London. Jack, I want to come straight to you, sir. It's a question I get asked a ton, a lot, particularly over the last couple of days, and I don't know how to answer it. What is the plan from the Europeans to kind of disconnect what's happening with gas and what happens with electricity?
Well, I think, you said there's been some good news. If you want to look at the good news, the gas price, the power price for Germany, the 1 year forward power price is down almost 50% today compared to the high it hit a couple of days ago. The bad news is that's still 11 times higher than it was at the start of last year. So we're in this moment for gas and power markets that is enormously volatile, but fundamentally the markets are telling you Europe has a really big problem this winter. We need to reduce demand significantly, and so far we don't know what the plan's going to be for that.
Jack, have they given any idea of the detail? Because they say they can do something about it, and clearly people are starting to think that maybe they can. What can they do, if anything at all?
Well, this is going to be the question. So we've got a meeting of ministers in Brussels next week. They're clearly going to be looking at something like capping power prices, trying to maybe copy the Spanish model, which has put a cap on power prices and then put subsidies to try and keep gas-fired production and stay competitive in the gas market. The problem is you need to reduce demand somehow or other. That's what the market is telling you. The market's way of doing that is to push prices up and to the point where people stop buying it. If politicians are going to intervene in the market, they need to come up with an alternative way to reduce demand. And so far we have very little detail of that. And we're really heading to a point where we may have blackouts this winter in parts of Europe.
We're waiting for that detail. And Lizzie, the ECB is about to hike maybe 75 basis points into this mess. Lizzie, can you frame inflation this morning and what it means for next week?
Yeah, Bank of America and Goldman Sachs joining Danske Bank in the prediction of 75 basis points next week. It's not just because of this inflation print, although you are seeing euro area inflation at a new record high, 9.1% in August, which is despite oil prices falling in August, which means it's broad-based, which means it's more likely to last. But economists are also being swayed because of all this hawkish commentary we've had out of the ECB. You've had 6 members of the Governing Council now saying that a move bigger than a half point needs to be at least considered. So money markets are seeing a 60% chance of a 75 basis point hike. Let's not forget you've had 2 75s out of the Fed. Jay Powell very clear in his messaging at Jackson Hole. That's hard for the Governing Council to ignore. So the plan would be, at least from the hawks, to front load the hikes, get on top of inflation expectations and avoid being unnecessarily brutal, as Francois Villeroy put it, later.
Lizzie Burden, thank you. Jack Fauci, thank you to you too. As Lizzie mentioned, the hawks are lining up. We heard from the Bundesbank president yesterday before this CPI print. We heard from him again afterwards. He's looking for decisive action. Going into the CPI print this morning, he said we shouldn't delay the next interest rate steps for fear of a potential recession. You can hear what they're telling you right here. They are willing to hike interest rates into a recession. What does it mean for the currency? We've got a big move for the ECB next week. Stronger currency, weaker currency. That is still an open debate. Had a weaker euro this morning. Just a slightly weaker euro right now. Sterling a whole lot weaker. Sterling came very close to breaking 116 early this morning. In fact, the intraday low was 116, the pound against the US dollar. The team this morning over in London, caught up with Charlie Bean. He's the former Bank of England Deputy Governor. And this is what he had to say about a large sustained deficit in the medium term at risk because of the incoming Prime Minister, if it is Liz Truss, talking about plans to cut taxes and raise spending. He said the following: I could see investors starting to think that the UK doesn't look such a good place to invest. You'll see a risk premium re-emerging on gilts, which is just starting to happen. Stephen Gallo over at BMO picked up on some of this commentary, and he agrees. He thinks that this is not just going to be a gilt issue with a risk premium returning, but also an issue that shows up in the currency. And you can see that in pound sterling this morning. And here's the issue that people have got in Europe, particularly the UK, and for the whole of the Europeans. You can have policy intervention on the fiscal side if the bond market's wide open. Back in spring 2020, in a world of low rates, QE, and low inflation, wide open. In a world of high rates, QT, and high inflation, that bond market is not as wide open. And if you're worried about the deficit in the UK right now, there's two ways you can look at attracting international investors. One, you can get rates up, gilt yields have to go higher, or two, the currency has to depreciate, or both. And that's the risk that this starts to feed on itself, and that's the risk people are starting to talk about in a bigger way in the UK. Cable right now, 116.17, we're down about a third of 1%, and that is a weaker pound sterling. Bit of breaking news out there for you as well. I want to cross over to Abby for that. Hey, Abby.
Hey, John. Well, we do have some breaking news. We have a few pieces of breaking news, but the one that has come out right now is the FDA has okayed the Moderna and the Pfizer-BioNTech Omicron COVID-19 booster shots. Both of those stocks are higher. The last I looked, Moderna was up more than Pfizer. Both stocks are again higher. Also, we had the news that the Chicago PMI came out a little bit better than expected, above 50. That, of course, highlights ahead of the ISM print that will come out tomorrow and Thursday. Will or will they not be above 50 as well? An important tell on the economy and whether there's contraction or expansion. The U.S. PMIs overall suggest that there could be some contraction, but we do have that Chicago PMI coming out positive.
Abby, thank you. 23 minutes in. Nice bounce back here, up 0.6% on the NASDAQ, up a little more than 1 full percentage point. Trying to take a bite out of the losses of the last few days. Up next, your trading diary. 26 minutes in, equities higher by 5 or 0.6% on the S&P, on the Nasdaq by more than 1%. That's the price action. Here's the trading diary. Let's get straight to it. The White House press briefing coming up at 2:45 Eastern. Fed speak from the Dallas president, Lori Logan. Then Atlanta's Raphael Bostic speaking at 6:30. ISM manufacturing, another round of jobless claims coming on Thursday. Get durable goods and factory orders on Friday. And the main event on Friday too is Payrolls Friday. From New York, this is Bloomberg.
This is Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, August 31st. Here are the top market stories that we're following for you at this hour. Bed Bath & Bust. The retailer is selling stock after a meme rally, cutting 20% of jobs and closing 150 stores. That stock is still down by about 22%. Oh, snap. Job pain. Snap also cutting its own workforce while ADP data disappoints. We break down just how bad the labor market will have to get for inflation to come down. And no price peak over in Europe. Inflation hits 9.1% in August. Goldman Sachs, Bank of America say the ECB will have to hike 75 basis points next week. From New York, I'm Alex Steele. My co-host in London, Anna Edwards. Guy Johnson is off. Welcome to Bloomberg Markets. Also, Anna, we finally made it through August, and what a month that was. I mean, equities really mixed. Bonds feeling a lot of pressure.
Yeah, absolutely. I understand it is the last day of the meteorological summer today, which is just too depressing, so I'm not going to think about that. But you've covered it all in the headline stories you just mentioned there, Alex, in terms of the day. The jobs focus persists. A lot of jobs focus running into today and from today, of course, whether it's tech or the data coming out of the United States. A lot of focus on the ECB as well, and that narrative has really been building since Monday.
Yep, and you have Mr. Holtzman, also the ECB, talking up 75. Well, we will definitely get to that within the next hour as well.
Yeah, absolutely. So we've got the market increasingly thinking about that 75 and factoring in, pricing in 75 basis points from the ECB when we get to that ECB meeting next week. Let's turn now to our question of the day. And this goes back to the jobs numbers and the jobs market and the state of the jobs market in the United States. How ugly does the job market get? And really what we're trying to do here is we get an assessment of how weak the job market has to get for inflation to come down. Are we talking about Nehru? Are we going to get really granular, really detailed and really economic about this? Let's do that. Let's discuss with Anna Wong, Chief US Economist for Bloomberg Economics, who's with us, and Michael McKee, Bloomberg International Economics and Policy Correspondent. Anna, let me come to you first. So we are primed for some weakness in the US jobs market. We've seen a little bit of that today. The ADP wasn't necessarily weak, but it wasn't as red hot as many had feared it might be. So we're primed for some pullback in the US labor market. How weak does it have to get, though? We know the Fed is going to tolerate some pain. How weak does it have to get to weigh down on inflation?
Well, I think the most optimistic case is let's look at what the Fed themselves wrote down in the SEP back in June. They see that unemployment rate has to eventually rise to 4.1% in 2024. So that's about 1 million job losses from today's number. So that's the optimistic case. But our team is thinking more that inflation would be a more persistent problem, and the Fed will eventually have to hike rates to 5%, and that would correspond to an unemployment rate of about 5% in 2024. That would mean 2.5 million job losses from today's unemployment figures.
So, Mike, is the Fed prepared for something like that? Because in theory, they want that to rise because labor force participation rate is rising, not because Bed Bath & Beyond and Snap are laying off 20% of their workforce.
Well, companies are always laying off people because they're doing bad.
20%.
They're doing well, but it's the company that's doing badly, not the economy in this case. And that's the line we'll cross, is when companies feel like successful companies that are making money, they feel like they have to lay off people because they don't have enough business. Now, the Fed, they say they are prepared for that. They don't think they're going to go that far because they're on the optimistic side of what Anna was saying. But do we see that this go to 5? The problem is they don't know at this point, and the market doesn't know, so we're all kind of trusting. If we get above 4.5%, then the Fed starts to get worried because they think that's roughly the natural rate of unemployment. After that, then you start talking about the possibility, at least in their minds, of recession.
Right. And Anna, I mean, let's think about what is driving this inflation and therefore what implications there are for the labor market. Because if inflation is being driven, yes, by demand factors, and that's where Fed policy can have an impact, weighing on aggregate demand to try and bring it down. But it's also being driven by supply. So might we find ourselves in a situation where we have a weakening jobs picture because of what the Fed is doing, but inflation is persistent?
Well, I think the first lessons, and that Powell cited as the key lesson from 1970s, is that the Fed needs to know that regardless of the source of inflation, whether it is supply shock or whatnot, the Fed needs to bring inflation down. So, and I think Volcker demonstrated that, inflation is everywhere a monetary phenomenon. So the Fed will have to do what it has to, and Powell said so very clearly at Jackson Hole.
Anna, let me throw a question at you. The Fed has been pointing to the JOLTS numbers as a sign that the labor market is really strong, and they also worry about it because it suggests that wages are still going to have to rise to attract workers. But there's a school of thought that the JOLTS numbers are not accurate, that there are a lot of leftover job notices that companies don't really intend to fill anymore. What does your model show?
Yeah, so I think the worry that the jobs opening number is not accurate is a valid concern because, some of the duplicates on Indeed.com or, Glassdoor, whatever. So those could just evaporated or those are just, fake listings. But however, I think the errors still is not as important as the trend. So I think the Fed would not put too much emphasis on month-to-month fluctuations. That's why Powell said that they would consider the totality of data. And I would say that the totality of data in both JOLTS and the non-farm payroll and ADP and ECI, wage growth number, all point to the job market being stubbornly red hot.
Yeah, and you saw that in wages too. Mike, this is the first time I think, right, ADP did wages also in the number. Like, what did we learn? It does feel like you could make an argument for a wage price spiral, no?
Well, I think the only thing we can say for certain is that wages have been rising. I mean, it's 7.6% on a year-over-year basis, ADP says, in the month of August. But we really don't know their methodology, and we don't know with accuracy what prior numbers were. They say this is sort of flattening out, but it's still high. The Atlanta Fed has a wage tracker that shows similar data. It may be useful down the road, but we're going to need to have some months of experience before we know. And as I say, we know that wage growth has been high. Now, you look at average hourly earnings, which we're going to get on Friday, they've flattened out, even though the unemployment rate has gone down a little bit and stayed very low. So does that suggest that maybe companies are not having to pay up and maybe those JOLTS numbers aren't accurate? That remains to be seen. We have to see, as Anna said, the totality of all the data.
Yeah, the totality of the data. So they're watching many of these data points then. Anna, are we still thinking about the possibility of a soft landing for the U.S. economy? I'm not entirely sure how we define that. You can help me out on that one. But one piece of reporting by our colleagues at Bloomberg News today says Powell has abandoned the soft landing goal, and there do seem to be people who are interpreting his comments about pain at Jackson Hole in that way, saying he's not about a soft landing anymore.
Yeah, I think from the remarks of several FOMC officials, it's clear that they are inching away from the soft landing hope, and I think that's a good thing. But in terms of definition of soft landing, I would say that what the Fed wrote down in the June SEP, 4.1% unemployment rate, would be the soft landing mark of between 4.1 to 4.5. So I think the baseline from the point of view of FOMC is that job losses have to rise by about at least 1.5 to 2 million by 2024 in order to rein in inflation. I think that's the baseline now.
Quick question before we go. Anna, Diane Swonk of KPMG was talking about a growth recession today. What is that? If it's not a soft landing, what's a growth recession?
I have never learned that concept in my PhD program either, but as I learned today, growth recession is defined as positive GDP growth, but it's not positive enough to keep unemployment rate from rising. That's growth recession. And that's probably what Powell meant when he said that GDP has to grow for a sustained period below potential growth rates.
All right, guys, thanks a lot. We really appreciate it. Yeah, it sounds like a quiet kid. It's like an oxymoron. It's not a thing. Bloomberg's Mike McKee and Anna Wong, thank you so very much for joining us. Coming up, we're going to continue the conversation why investors should focus more on earnings, though, than what the Fed is doing. We're going to talk to Morgan Stanley's Chief U.S. Equity Strategist, Mike Wilson. That's coming up next. This is Bloomberg.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
Fed at this point in time has said a lot of things that a lot of people who had been more critical of the market rally already understood, that the Fed was going to take inflation seriously, that the Fed was going to tolerate some pain. And I think in particular, the idea that they're going to be willing to tolerate some pain on the labor market is something we really have to dig into.
That was RBC's Lori Calvasina on Fed's pain threshold and the labor market, which also leads us to the question of the day, just how ugly does the job market get? And then what does that wind up meaning for the equity market? Chief U.S. equity strategist at Morgan Stanley, Mike Wilson, thinks investors are way too preoccupied with the Fed. And I get that idea, but there is the line between earnings and the Fed, right? I mean, if we're going to see 5% unemployment, we already see 20% jobs cuts at Snap, say Bed Bath & Beyond. What does that mean in your world?
Yeah, I mean, look, the Fed is relevant. I just think that, we've priced most of the Fed pain in the first half of the year, right? All of the PE compression that we experienced was due to the Fed, getting around on the inflation risk, rates going up a lot. And then, multiples came down by 30%. And, we break down the reason we can make that statement about the Fed is sort of priced is when we look at the PE ratio, we look at two components, the 10-year Treasury yield, which is the cost of capital, which is what the Fed sort of controls. And then you have the equity risk premium component, which is really the market's way of discounting the risk to growth. And the interesting thing to us, Alex, this whole year, the equity risk premium has not risen at all. In fact, it's well below where it was at the beginning of the year today, even though we think the earnings risk is now upon us, right? We're cutting numbers, and we think the numbers are going to come down even further over the next 2 quarters. So the bottom line for us is the PE multiple is wrong again, not because the Fed is going to be hawkish, but because the equity market is being too optimistic about the earnings outlook. And usually the way that resolves itself is the multiple will start to come down as earnings get cut. And then somewhere in the middle of that earnings cut process, the market will bottom. And we think that's probably sometime between September and December.
Okay, and how painful will that fall be then, Mike? Good to see you. How painful will that fall be before equity markets bottom and find their way out of this then?
Yeah, I mean, look, we've already had a lot of pain, obviously. So I think for the average stock, if I look at the market in June, we had one of the lowest breadth readings, in history. And that's why people got excited with this rally, because we had what we call a breadth thrust, meaning a lot of stocks participated in this rally. And that is technically potentially a good indicator. However, the index usually is the last thing to fall. So meaning June probably was the low for the average stock, but the index, we think, still has to take out those June lows. We've used 3,400 for kind of the quote-unquote growth recession or soft landing, as you might want to call it, or a proper recession would be something closer to 3,000, where the numbers actually come down quite a bit further. So we're below the street on earnings estimates right now. We're probably, going to have to take those down lower, as everybody else is too. And it's a guessing game. Nobody knows the answer, but the direction is down at least for the next quarter or two.
Hey, Mike, the reaction function right now seems to be good news for the economy equals hawk Fed equals bad for markets. Do you agree with that? And is that the right way that you're looking at data that we get?
Well, I mean, this good news, bad news, or bad news, good news. I mean, I think the problem I have with all of that, Alex, is the following, which is, it's a little bit frustrating to me when, you see people comment about, the earnings or economic data, and their conclusion is based on the price action. So in other words, if the market is up, people say, oh, it was already priced or it's good enough, wasn't as bad as feared. Not really doing the analysis like, well, just do you think it was a good number or not? And I think if you're objective about the data right now, it's not particularly good. And yes, in certain situations, maybe it's not as bad as feared. Okay, fine. But the trajectory that we see, our analysis suggests that the second quarter was pretty bad. And the trend on operating margins in particular was worse than we expected. And we don't think that that's going to be a one-quarter affair. So I think bad news is bad news because the news is going to get progressively worse. I think the risk that people are taking right now in assuming the worst is behind us on the revisions is a bad one. I mean, particularly with multiples having bounced off those lows in June. And that to us is you just got to focus on your own analysis and not focus so much on price action to let you tell you what's going on.
It did seem to, in keeping with what you're saying there, Mike, it did seem that last quarter we still had a lot of executives saying, look, we've got pricing power, we can pass this on to our consumers. Do we have to go through to a period where those businesses don't have pricing power before we've seen the bottom?
Yeah, I mean, I think the bottom line is some businesses absolutely have pricing power, okay, but it's a small minority of businesses, and unfortunately, the companies are the last to know, okay? I mean, that's the reality of it. When at turning points, major turning points like we're in right now, I find that, company management teams tend to be not very good forecasters, right? It's not what they do for a living. I mean, that's what we do for a living. What they do is they run their businesses really well, okay? And they can do that operationally. But it's hard to steer, it's easy for me to forecast the future and say, okay, here's what's going to happen. If I'm running a business, it's much more challenging because I got to make real decisions about hiring, investing. So, I'm not saying that pejoratively as if, management teams don't know what they're doing. I'm just saying it's very hard to forecast, a major downturn, okay, when you got to invest in the business and then you have to make a decision, am I going to invest through this or am I going to try and be tactical? It's very complex. It's very complex.
Hey, Mike, on a granular basis, if I just look at the last month, energy in the S&P up 1.8%, tech down 5%. What do you do with those two sectors now as we head into the last couple months of the year?
Yeah, I mean, it's interesting. Energy is like, when people say S&P X financials or X, tech or something. I hate when people do that, but we are going to do that right now. S&P X energy, okay? And the reason I think it makes sense to say that for X energy is because energy is really, the antithesis for everything else. Like when energy is doing well, it's usually bad for everything else. And so if you look at the earnings estimates and you look at the trajectory of what's happened this year, energy's been a big outperformer, both in terms of earnings results and in terms of stock prices. That's not necessarily a good thing for, overall earnings power and for economic growth and for the overall market. And so I think we're going to continue to see this divergence, where energy continues to probably do relatively better. Technology, I think, is diametrically opposed to that because it's bad for the economy. Same thing for consumer discretionary. So that's how we're set up. I mean, we're actually neutral on energy, but we're taking some individual stock bets, but we're underweight the cyclical parts of tech and consumer discretionary on this idea that energy prices and inflation are going to remain, elevated.
Yeah, we've seen those two diametrically opposed in just today's session here in Europe, but I know it's a very long-term theme. Mike, we started this conversation thinking about the labour market, and you've talked about all the things that go into your models, well, some of them at least, to do with risk premium in equity markets and treasuries. How does labour market statistics, how do labour market statistics find their way into your models at all, if at all?
Well, it's interesting, the Fed focuses on its dual mandate of price stability or inflation, and then of course, full employment. The problem with that mandate is it relies on two of the most backward-looking data series that we have, right? Labor market data and then inflation. So the Fed is always going to be late by design. And I think it'll be the same thing for the labor market. But by the time the labor market falls apart, it's too late, okay? So, it's clear that the labor market is softening in certain areas. It's sort of very robust in other areas. And so I don't think you can declare a recession until unemployment goes up by 200 or 300 basis points. And the Fed would agree with that, right? They've said that many, many times. And I think it's just going to be a late indicator. By the time we get negative payroll data and unemployment up 200 basis points, it's going to be obvious to everyone that we're in a recession and the damage has already been done. So unemployment for us is an important variable from an earnings standpoint as well. Companies do cut costs when you have a slowdown, and labor is a big component of that. The one thing that's unique about the COVID recession is that we lost a lot of labor participants. And one thing that bothers me a little bit about this recession is we may see companies not want to cut labor as much this time because their employees are so precious now. And if that's the case, then unfortunately the earnings degradation will be worse than normal because they're going to have to carry those employee costs as business is slowing down. That's an unknown at this point.
Thanks so much. Thanks for your thoughts, Mike. Mike Wilson, Morgan Stanley's chief U.S. equity strategist. Thank you very much for joining us here on Bloomberg TV. Coming up, back to your desks. Apparently, two of Wall Street's biggest banks tell employees there's no longer any reason not to be in the office. More detail and nuance behind that story. We'll get to that shortly. This is Bloomberg.
All right, Goldman and Morgan making it very clear, get your staffers back into the office. Those banks are now easing some of their COVID restrictions. I just want to get more on this with Bloomberg's Sonali Basak. Sonali, I'm just interested to see sort of how this affects employee mentality. Because I feel like if this call was made 8 months ago, people would have just walked.
Well, it's very interesting that you're saying that because the whole return to office drama had started a long time ago. And Goldman was really at the forefront here, bringing back employees much earlier than most of the other banks and asking people to come in full time as much as possible. But this isn't just about that. This is turning the page of the COVID pandemic a little bit more and saying we're going to lift the restrictions as well. Remember, this is also dependent on region. If you're in New York, there's still a vaccine mandate for workers. There's some exemptions. But other than that, the testing requirements are being lifted, and so are certain requirements as it comes to quarantining if you've had exposure and wearing masks if you've had exposure. This changes depending on where you are. Of course, Morgan Stanley had their own employee notifications about this too, and they're taking away the notifications as it comes to the health. You know that email you get when your colleagues have COVID, you no longer get those emails anymore.
Okay, so it's interesting that there's this regional disparity then perhaps building here, Sonali, or at least evolving. What about incentives? Some of these businesses brought in, freebies, free lunches. I feel I should put that in quote marks for employees to encourage them back. What's happening to all of that?
It's a great question here because one of those freebies and one of those perks were those COVID testing kits that you got. And those are things that are also starting to be rolled off and starting to go away as well. Insurance will cover some of them as needed at Goldman Sachs is what they told employees in this memo. But listen, Anna, a lot of those perks went away a long time ago. The idea of free travel, Ubers around, some of the food stipends that were given, the free food in the office. But that was expected to go away at some point. Really, this is a matter of the page turning post-Labor Day into a tough economic environment, and now people realizing that they need to get back, and they need to get back faster than they have been.
Sonali, thanks very much for the update. Bloomberg's Sonali Basak with details there. Goldman Sachs, Morgan Stanley and their policies. Some differences between them, but interesting to pull out those common threads. Coming up on the program, more signs of sluggishness in the U.S. housing market. Mortgage applications fall for a third consecutive week. What does supply look like? We will talk to Howard Lorber. Bloomberg.com.
We're about an hour into the U.S. trading session on this last day of August. I feel like we made it through a pretty tumultuous month. Bloomberg's Abigail Doolittle is looking at some of those moves for us. Abigail?
Well, Alex, it really has been an interesting month. And if you think back to the beginning of the month, you might have thought that there would be a rally, but not so much. So let's go all the way back to 2020 and take a look at the setup for this year. So you had this big rally in 2020 out of the pandemic lows, steady as she goes. And then this year struck, January. So the NASDAQ in particular down 6 months out of this year. But you can see August right now for all the major averages, if we were to include the Russell 2000 down, that after the big rally. This chart, even from this perspective, may answer the question of whether or not that rally was a bear market rally or if it was something real. This decline in August suggests that it is a bear market rally, was a bear market rally, especially given the fact that September is the most seasonally difficult time for stocks. As for the impetus for the pressure on stocks this August, take a look at this. This is unbelievable. Yields really backing up. The 2-year yield, 10-year yield, and 30-year yield all sharply higher. But of course, the short end of the curve higher on the expectation that the Fed will likely be raising rates by 75 basis points in the September meeting. That, of course, is giving support to the dollar, up 2.2% in the month of August, up in a big way this year and last year. That makes all risk assets stocks and commodities look more expensive. Take a look at oil over the last 3 months. We now have 3 down months in a bear market over that time period. This is the worst performance since oil going back to the beginning of the pandemic. And Anna, I was mentioning how September is the most difficult month for stocks. I would have thought it would be October, but it really is September, and especially for the NASDAQ. You can see the NASDAQ over the last 5 years has tended to do well on a monthly basis, but in September, down 0.6%. So here we are in the last day of August, down 6 months out of 8 months for the NASDAQ, going into that seasonally difficult time. It could be a challenging fall, to say the least, Anna.
Yeah, that does not bode well, does it? Abigail, thank you very much. Bloomberg's Abigail Doolittle with the latest on the markets. Let's talk housing. Mortgage applications in the US fell again last week, down by 3.7%. What does this tell us about the housing market? With us now, the chairman and CEO of Douglas Elliman. That is Howard Lorber, of course. Douglas Elliman is one of the largest independent residential real estate companies in the United States. Howard, very nice to have you with us. Tell us how does the market seem to you? We look at interest rates on the rise, quickly on the rise, and with big leaps, and we think this must be applying pain to the market, and we see headlines that suggest it is. How does it feel to you?
Well, the headlines, I think, basically are wrong. When you say we're in a sluggish market, it's only sluggish compared to the bull market of 2021, which was post-pandemic. So I think, a sluggish market, we're still probably better shape than we were in 17, 18, and 19 before the pandemic. And just even in the last couple of weeks, the tracking of contracts over $4 million in New York City, 2 weeks ago there were 8, last week there were 21. So I think that things are pretty stable. The high-end market performing probably somewhat better than the more moderate markets. But again, and as it relates to interest rates, yes, you can worry a lot about interest rates, but the fact is, yeah, inverted yield curve, and really what that shows is that at some point, rates are going to be coming down.
Howard, I'm curious, talking about the high-end market, what kind of deals are we seeing? In that, are we still seeing all cash deals? Are we still seeing a lot of contingencies being waived like it was a year ago? Or has that crazy hotness moderated?
No, that has moderated, but that surely doesn't make the market sluggish. I mean, how long can a market, if you look at Florida, for instance, and you look at Palm Beach in particular, those prices were up 50 to 100% in 1 year. So how long can that continue? So and they're not even going down now, they're just moderating in price. No more big price increases, and more inventory now starts to come on the market, and that's when it starts picking up again.
Yeah, I was going to ask you about inventory, Howard. How does that look right now? Because if people have been reading the same gloomy headlines, you say they're misleading, that I've read about the U.S. housing market, maybe they don't feel like they want to sell. But what do you expect to see then in inventory?
Well, again, just to start with, sluggish is a state of mind, okay? And what do you compare it to? So I think it's pretty much unfair for a lot of people just saying sluggish. Because again, it's only sluggish compared to 2021. Right now, typically what happens during the summer months is the inventory builds up. The inventory goes down because brokers are telling customers people are traveling. It's not a great time for sellers to go on the market. And then all of a sudden, come September, after Labor Day, more inventory comes on the market, and more inventory coming on the market brings more buyers into the market. And as it relates to the high end, I can only tell you that we sold 3 apartments that were 2 for around $75 million and 1 for $50 million this year so far.
Wow. Okay. That's a lot. So can you just help me understand then, if we go from hyper growth, then there's the normalization bucket, then there's an actual slowdown. You definitely feel like we're not in a slowdown yet. Obviously you feel like we're in sort of maybe a normalization. Do we get to a real material slowdown if the Fed keeps hiking? I know you said about the yield curve, but if we're looking at 4% plus for a terminal rate, do we get a sluggish housing market?
This country for so many years has been on the short end of housing supply. So I don't think that is going to happen. I think that, again, the realization is that markets can't keep going up. There may be some slowdown, but I don't believe it's going to be a big slowdown. I think it's just going to be a normalization. Again, you have to look. You can't look at 2021. You have to look, because probably the peak year before that was around 2015, 2016. Starting in 17, it started going down, and 18 and 19, and then 20 when the pandemic started. And then all of a sudden, what happens? 2021 comes, and everything goes up. I think the average price increase in all the markets was something like 18 to 20%. Now, we've never seen that before through the whole country.
Yeah, so there's still been some normalizations to go through. Howard, what about foreign buyers? I mean, the strength of the dollar has been putting some of those foreign buyers off, but are there signs that that's changing?
Well, I'll tell you, yes. And again, the example I gave you of those three apartments, 275 million, 150, all three were foreign buyers. And you know, foreign buyers are the very high-end foreign buyers. Maybe are doing it for different reasons. And I've said this a couple of times before, and last time I was with you on the show, that I believe that New York City is going to be and is becoming the #1 second home market to the world, as opposed to what probably was before London. But all these buyers, all these high-end buyers now are coming out. They're coming out. Yes, they're paying more because their currencies are weaker than the dollar. But you know what? They think it's where they want to be, where they want to have a second home.
I hear what you're saying about the high-end market. I know that's what you guys are going to specialize in, but do you have any visibility into the more moderate end, like somewhere between like 500 and 2 million or even 3 or 5 million? How's that section of the market doing?
That section's doing okay. I mean, it's not as strong, but that section always does okay. And that is interesting because, yes, I think people at those levels are more worried about interest rates and the mortgage rates, okay? When you're in a high-end market, you don't really worry about that so much. So that has hurt. But I believe that sometime this year, those rates are going to moderate, and then we're going to go into a better environment. It's not going to go, it's not going to go to where it was, because, you know, not too many people in their lifetimes have ever seen mortgage rates be as low as they were. So it's going to moderate, but it's still going to be good, and people need to buy houses.
Yeah. 275, Howard, is my fixed for 30. I'm just saying. I hear you.
Yeah.
I'm not moving forever.
Would you be happy with that?
Oh, yeah. Oh, I'm happy with it. Don't you worry. I'm very happy with that. Howard,
and by the way,
yeah?
even if it's 3 or 325, it's not so bad.
No, it's not. But, you know, 275 to 5 for me would make a big difference. But I hear your point, Howard.
That's a different story. 5 is a different story.
It is a different story. Howard, good to get your perspective. Super appreciate it. Howard Lorber, Douglas Elliman Chairman, President, and CEO. Thank you so very much. All right, coming up, back to the markets. UBS now saying the credit markets are underpricing a recession risk. We're going to speak to the strategist behind that call, Matthew Mish, coming up next. This is Bloomberg.